Well, for more on the markets, joining us now is Brian Belski, Chief Investment Strategist at BMO Capital Markets. So we're going to be looking at some trends and some picks, both in the U.S. and Canada, but starting with the U.S. today. Thanks for coming in.
Let's do the U.S. How are you, Nancy?
Yeah, might as well. I'm good, thank you.
Thanks so much for having us.
Yeah, of course. So today in the U.S., the CPI data is a big focus, of course. And, you know, it can push things one way or another, markets one way or another. It does seem it didn't help anything today, but I'm not sure that there was a really clear read from CPI. What did you take away from it?
No, that's a wonderful way to put it. And I think we're so sensitive and intense with respect to any kind of negative movement with respect to inflation. I think that's why the markets reacted. With respect to the absolute number that came out, it wasn't a real surprise. And it doesn't change the overall long-term trend. I don't think enough's being made, and I'm not an economist, nor do I play one here on BNN Bloomberg. But the makeup of medical expenses, as defined by the Bureau of Labor Statistics, changed. And should come as no surprise that that was coming, but apparently people weren't expecting that. But I still think the lagging effect of housing and affordability of that is really what's dragging that. And then we also know, too, if you just do math, that the month-over-month change in oil prices, September versus October, was much heavier. September to October was not as heavy. So September to October was not. So I think the trend is still in our favor in terms of inflation going down. And I'd be very surprised if the Fed raises rates again, especially considering the increased volatility around the world, and especially the atrocities that are going on in Israel right now.
You'd be surprised if they raised rates again, period?
Period.
Not just, okay, yep.
Period. Because the economy's slowing. We know that, but we don't think we're going to see an actual contraction, according to our great economics department at BMO, in terms of the U.S., like a negative GDP number for 2 quarters in a row. So we're seeing the proverbial soft landing according to their models, and of course we agree. And I think the wherewithal of the U.S. and Canadian markets were well displayed this week. You know, when people are worried about what's going on in the world, they come back to stability. And stability has always been offered by North American markets, America and Canada. We've seen such a surge in yields recently, and I wonder where you see things sort of settling, what sort of influence that you're seeing them have. Well, we've seen yields rest in here a little bit on a short-term basis, but September, when we did see those inflation numbers go up, and we did see some more worries about with respect to what the path of inflation, plus the stock market didn't do so great in September as well. So remember, stocks go down in September and they bottom in October. That's the easiest way to kind of think about it. And this is all part of kind of returning to normalized historical patterns. And it's something we've been talking about for the last several months, but it's kind of been lost in what's happened with the market so far this year in terms of stocks, with so many people focused on the Magnificent Seven and higher interest rates. And what we have tried to continue to tell investors, Jacqueline, is that stocks can go up in a higher rate environment. And in fact, stocks actually do better in a higher rate environment than they do when interest rates are going down. We've got a graph of yours that I think ties into that. Can you tell us a bit about what we're looking at here? So if you take a look at the return of stocks post the great financial crisis, it's actually not as good as when pre-financial crisis, so 1990 to 2007, when interest rates were actually gliding higher. That's basically what that's telling you. And so a lot of people have only been in the business, say, 10 or 15 years. So now we've reared an entire generation of investors that only know that you buy stocks because stocks go down. That's actually not fundamentally accurate, because interest rates stay high, Jacqueline, because the economy is strong. And oh, by the way, the economy is strong. Let's talk about a couple of individual stocks. Uber is one that you like right now. And I wonder, how you're thinking about Uber with the sort of volatility and energy costs. So on the Uber side, we just purchased the stock for the very first time. I like to see how stocks do coming out of being a new public company and new management teams that we've seen. And we just purchased it for the first time September 1. I love longer-term themes of scarcity. It is the play. And they're getting into package delivery now. And they're the kind of one-stop shop on that. And I know in summertime, I live in Minneapolis, Uber Eats is way better than Grubhub. Just a little sidebar thing there. But I think on the fuel cost side, and you got to be careful too on the sector side, why Uber is important if you're a portfolio manager, is Uber's in the industrial sector. Okay, so Uber gives you a little bit growthier numbers and a stronger trajectory. Lastly, there's been some speculation that Uber could be added to the S&P 500 next year, meaning that index investors have to own the stock. So I think it's one of those under-owned stocks in terms of the growthier areas, and they've got a great leadership team and a great kind of market.
You also like McDonald's. Maybe you're getting
The other
your
end of the
Uber
spectrum.
to deliver your McDonald's. But what are you thinking about when it comes to the U.S. consumer and a name like McDonald's?
Well, I take a look at McDonald's as an opportunity to bond if the stock is clearly underperformed. I think it's going to benefit from AI and this whole notion of the consumer potentially trading down. We like this whole notion of comfort food, too. If we're worried, oh, there's nothing better than some French fries and a Diet Coke and maybe like an Egg McMuffin, and it's delicious. But I think people have kind of migrated away from that, and I think if people are starting to worry more about the economy, this is going to help McDonald's a lot.